One of the biggest reasons that traders struggle isn't because they don't know how to trade, it's because they don't know when not to. Most of their losses don't come from bad entries, they come from trading when conditions are unclear, conflicting, or unstable. So in this video, I want to break down when it makes sense to trade, when it absolutely doesn't, and how to use macro events to decide whether to stay in, stand aside, or reduce your risk. This is in regards to if you were asking how I know if there's anything stopping me from taking a trade from a macro perspective using news, sources, and upcoming events, and how I approach the same information when I do decide to trade. Whether you are a swing trader, a day trader, whatever kind of trader you are, if you can master this, your results will change. Not because you trade more, but because you trade less and at the right times. Before we jump into this video, I just want to give a big Merry Christmas to everybody watching. And if you don't celebrate Christmas, happy holidays, but let's jump into this video. The first thing I want to talk about is that trading is a weighted decision. It's not a signal. Most traders treat trading like a checklist. A signal appears, they enter a trade and hope it works. That is very backwards to me because trading is a weighted decision, not a trigger. Every trade is a balance of probabilities, and macro is one of the biggest weights on the scale. When traders ignore macro, they're essentially saying, I don't care what's happening in the world, my setup will work anyway. This mindset is why so many good technical setups fail. The key shift here is your job isn't to find more signals. Your job is to determine whether conditions can support acting on them. I want you to picture every trade that you see as a seesaw. On one side of the seesaw, you have higher time frame structure, trend alignment, macro tailwinds, and sentiment with positioning. On the other side, I want you to think about opposing data, upcoming high impact events, conflicting macro signals, thin liquidity, or abnormal conditions. Your edge exists when one side is clearly heavier. If the seesaw is level, you don't have an edge, you just have a guess. So one critical question you have to ask yourself is, if the trade is at a 50-50, am I really happy risking capital on a coin flip? Professionals do not trade neutrality. They wait for an imbalance that gives us an edge. As you can see, with the only trades I've taken since October all the way through December, we've had 4 winners and 1 loser. Again, this could have been very easily avoided if I followed the rules to a T, but I did want to leave some risk on the table with this. And in all of these, we've had pretty quick take profits besides this last one, or we've had a very quick death. This is not by accident. This is all done on purpose because I'm only trading and taking positions when the market is showing me that it has room to move. This was an early positioning of a move that I anticipated with FOMC, so I was very happy sitting in this while we were just consolidating. All of these are pre-planned, and this is how your trade should be. The longest part about trading is everything up to clicking the buy or sell button. So I want to make this very, very real here and talk about a real example. So next week, we are actually getting FOMC meeting minutes. So if the tone were to come in more cautious on growth, acknowledging slowing conditions and leaving the door open for rate cuts easing, that shifts expectations around rates and yields, which is very constructive for gold longs specifically. So pretend that we had a perfect A+ setup on gold right now. We had an area of interest up here, respected a swing low, and a break and a retest of the area, and we're ready to go back to the highs. If we're at this point right here where I can take an entry and we just got those FOMC meeting minutes in and it's very constructive for gold, of course that I'm going to be wanting to take gold longs. The seesaw is favoring gold with macro, the higher time frame structure supports the upside, and the sentiment is aligning. That doesn't mean gold must go up, but it's an environment that supports the trade. And this is when trading makes sense. But macro is dynamic, it's not static. All that means is that can shift at the tip of a hat. Later in this week, we actually have unemployment data. If we have that gold long bias, and then later that week with unemployment data, the data comes in much stronger than expected, that'll signal a labor market resilience, and that will shift rate cut expectations, strengthen the dollar, and reduce the macro on gold's longs. Now the seesaw has started to level. So one of two things would happen at a time like this. If you were already in the trade, you would tighten your risk, maybe move some profits off the table, and especially move your stops to break even. With this, you have no risk essentially on the table, and either you can monitor the macro situation to see if something continues to support gold, or we're just going to be going for a break-even trade. You don't have to immediately take profits, but if you want to, and that's per your risk appetite, you're more than welcome to close the trade early. If you are not in a trade, it's very, very simple. You don't take the trade at all. There's no forcing, there's no chasing. Discipline here is knowing when the odds have changed. And that brings me to one of the biggest lessons I've learned in trading, which is the hardest skill to learn, is patience, and why waiting is a position itself. Most traders feel unproductive when they're not trading, but when macro inputs conflict, waiting is your trade. If you enter when macro conditions are unclear, you're not trading on an edge, you're just flipping a coin. Professionals don't get paid for activity, they get paid for selectivity. That's going to cause you to lose some trades, that is going to cause you to lose out on a lot of unrealized profits that you could have had, considering this gold trade right here, where we could have held this for a much bigger RR trade if that supported it. I told you guys that we just missed this trade right here by just a couple points from my limit order. That's thousands of dollars that I missed out on. But that is selectivity. That is me getting paid for my discipline. I'm not rushing. I'm not forcing anything. I'm letting it happen. The market will always be here, and there will always be more A+ trades. So this brings me to my next point. Once you're in a trade, the job is not over. This is where you're going to continue monitoring central bank policies, geopolitical development, shifts in risk sentiment. Every new piece of information either adds weight to your side or subtracts from it. If the balance shifts too far against you, you already have your answer. Don't argue with macro, just respect it and follow it. A new thing they just added on TradingView that I noticed today actually is they added right beside the ticker symbol some analytics. So you can actually click on news and see everything that's kind of going on with gold, data talk, delivery intentions breakdown, gold futures, bullish momentum. So you can actually check all of this right here on TradingView. You don't really have to go anywhere else for this. So this is actually really cool that they've added this, and I'm very interested in how this would work. I can actually make a separate breakdown on the research portion of this and maybe even take a look at TradingView's new instrument cluster here that we can actually probably use to do a lot of our macro. We also have seasonals here. This just showcases each year and where the chart has been at any given time per previous years. So let's hop back over to the chart because I have one of the most important rules for you to follow. Even if you have a dream setup, perfect structure, perfect bias, perfect entry, if a major surprise hits, that could be anything from unexpected tariffs, emergency policy decisions, geopolitical shocks, you have to be okay with doing nothing. That means this dream setup is effectively cooked. But yes, if you're already in a trade, price might hit your take profit level, but it can just as easily hit your stop loss in seconds. That is not calculated risk, that is just randomness. Professionals do not trade in chaos. And this is why most losses just come from bad timing. When traders review losing trades, they often focus on the entry, and that's the wrong place to look because most losses happen because the trade was taken during some uncertainty. Macro conditions were ignored. Upcoming risk wasn't respected. Timing matters more than being clever. The best trades don't win because they predict better, they lose because they avoid bad environments. As you can see here, we pulled profits very early on this trade right here. We actually went break even on this and only pulled a bit of profits, but look what happened if I did not break even this position. If I, just set and forget it. I know FXLSG is a savage trader, whether you guys might think otherwise. This trade would have come straight to SL just by holding it. And for this close to take profit, why are you keeping risk on the table? I don't care if it wicked all the way down here and came all the way back. I'm not holding this trade any longer because the worst thing to do is have risk on the table when you don't need to have it. I was very slick with this. I secured a little bit of profits that probably funded this trade right here that we got a quick sniper entry on and continued to the upside and hit a full take profit very, very quickly. With this trade in particular, you can see how we had a sniper entry, continued to the upside with great force. This would have been a 1-to-3 trade. I didn't just go for a 1-to-1 here. I just did that for the argument's sake of showing that the trade was still here to showcase this loss in the future. But with this in particular, at a 1-to-1 and seeing that there was policy shifting, I could have easily shifted this trade to break even, and we did not, unfortunately, and we hit a full SL with some brute force. Again, the best traders don't win because they're just predicting the market better than you. They lose less because they avoid bad environments. So I want to give you guys some non-negotiable rules that I follow. These are rules that I will never break. First, if the macro is conflicted, I don't trade. Second, if upcoming data can flip the narrative very quickly, I will reduce my exposure. If the seesaw is balanced, I wait. I'm not risking my capital on a coin flip. I have better odds going to the casino. 4. If surprise risk is high, I will sit on my hands. No expectations, no ego, no forcing. That is the benchmark of what my trading is built on. A quick summary on this, and just to summarize everything I went over, trades are weighted decisions. They're not just binary signals of a perfect setup. Macro can tilt the odds. It doesn't guarantee your outcomes, but it can sure give you a great estimate of what will happen with the markets. Again, it is just like reading a story, and you have to respond and act accordingly. If conditions do support your trade, you act. If conditions conflict, you wait. If surprise risk enters the picture, you stand down. Your edge isn't activity, it's your judgment. This is one of those videos where if you take anything away from this, is if there is even a shred of doubt, you do not take the trade. I don't care if you had the biggest feeling ever. I don't care if you're one trade away from passing your account. This is where traders will go wrong. If I have the discipline to only be taking 5 trades in almost 2 months, why do you need to be forcing a trade every single day? If someone can be more profitable with you by trading a lot less than you, what is the point of trying to find a trade every single day in all this kind of madness? Let the market tell the story that it's going to tell. follow that, use your judgment, and continue to refine your edge. Trading is not about finding more opportunities, it's just about avoiding bad ones. If you learn when not to trade, your drawdowns will shrink, your confidence will improve, and your winners will finally matter. The market will always be here. Your job is to make sure that you are too. If you guys found value in this video, make sure to leave a like, subscribe, any comments below of any questions you might have, or anything you want to see me break down on this channel. And with that, we'll see you guys in the next one.